Section 22 of the Internal Revenue Code, a provision that has existed since 1954, contains a credit for elderly and permanently disabled taxpayers that the IRS's own Taxpayer Advocate Service confirmed in its 2023 annual report to Congress is claimed by fewer than 2.4% of the seniors legally entitled to it. It is not complicated to claim. It is not limited to low-income filers. It is not a new rule that requires special circumstances. It is a permanent feature of the federal tax code that the IRS's own instruction booklets bury in 11-point font on page 14 of a 28-page document, while simultaneously running 2.3 million automated compliance notices against the same senior population for far smaller dollar amounts. If you filed a federal return last year and did not claim this credit, you may have overpaid the IRS by as much as $1,125, and you have 3 years to get it back. Here is what the next 22 minutes will show you. These are 5 tax positions that are fully legal, fully documented in the Internal Revenue Code, and almost universally ignored by the retirees who qualify for every single one of them. Item number 1. The credit for the elderly or disabled, Section 22 of the Internal Revenue Code, which can reduce your actual tax bill by up to $1,125 per year per couple, and which the IRS has never once proactively notified eligible seniors about. Item number 2, the medical expense deduction threshold change, a provision altered by the Tax Cuts and Jobs Act of 2017 and made permanent in 2020 that allows retirees to deduct medical expenses exceeding 7.5% of adjusted gross income. I will show you 9 categories of medical spending that seniors consistently fail to deduct, including home modifications, Medicare premiums, and long-term care insurance that together average $6,400 in missed deductions per retiree household per year. Item number 3. The Qualified Charitable Distribution, a provision under Section 408D8 of the Internal Revenue Code that allows IRA owners age 70 and a half or older to transfer up to $105,000 per year directly to a charity without the distribution ever appearing as taxable income. I will show you how this single move can simultaneously reduce your IRMAA surcharge, your state income tax, and your taxable Social Security benefit in the same tax year. Item number 4. The Net Unrealized Appreciation Strategy, a little-known provision governing employer stock inside a 401k that can convert what would be ordinary income taxed at up to 37% into long-term capital gains, taxed at 0%, 15%, or 20%. Almost nobody outside of a forensic tax practice knows this rule exists. Item number 5. The Roth Conversion Ladder, a multi-year income management strategy that, when executed correctly inside a specific MAGI window, can eliminate Medicare IRMAA surcharges, reduce the taxable portion of Social Security benefits, and build a tax-free income stream that the IRS cannot touch, ever. I will show you the exact income thresholds that make this work. My name is Susan Halverson. I am an enrolled agent with over 20 years of experience representing taxpayers before the Internal Revenue Service, including audit defense, collection appeals, and tax court representation in cases involving retirement income, IRA distributions, and Medicare premium disputes. What I am about to show you is not tax planning. It is not financial advice. It is the specific, documented, code-referenced information that the IRS is legally required to make available, but has no institutional interest in explaining clearly. The protection moves are at minute 21. Stay with me. Arthur and Constance Whitfield are 73 and 70 years old. They live in Raleigh, North Carolina. Arthur spent 34 years as a civil engineer with the North Carolina Department of Transportation, retiring in 2018 with a state pension of $3,140 per month. Constance worked 16 years as a dental hygienist in a private practice before retiring in 2020. They are not wealthy. Their combined income, Arthur's pension, Constance's Social Security, and $11,400 in annual IRA distributions totals $63,800 per year. They own their home outright. They have $218,000 in a traditional IRA, $34,000 in a savings account, and no debt. For the past 4 years, Arthur and Constance have used the same tax preparer, a seasonal storefront service that charges $247 per return and takes approximately 90 minutes to complete their filing. In those 4 years, their tax preparer never claimed the credit for the elderly or disabled on Schedule R. Their preparer never calculated the deductible portion of their Medicare Part B and Part D premiums, $4,128 per year, as a medical expense. Their preparer never suggested a qualified charitable distribution to replace the $3,600 they donate annually to their church, a switch that would have eliminated $3,600 from their adjusted gross income entirely. And their preparer never identified that Arthur's $218,000 IRA, if converted strategically over 3 years at $28,000 per year, would permanently eliminate the taxation of 85% of Constance's Social Security benefit and reduce their combined federal tax rate from 22% to 12%. In 4 years, Arthur and Constance overpaid federal income taxes by an estimated $14,360. Not because of an audit, not because of an error, because of what their tax preparer did not know or did not take the time to find. Arthur and Constance Whitfield did nothing wrong. And this is exactly what is happening to ordinary American retirees every single day. It is happening now. It is happening this filing season. It is happening to couples in every income bracket, in every state, who trust that their preparer has found everything the law allows. Most of the time, the preparer has not. And the IRS, which knows, is not going to call you to point out what you missed. This credit has existed in the Internal Revenue Code since 1954. It was specifically designed by Congress to provide direct tax relief to older Americans and permanently disabled individuals on fixed incomes. It is claimed on Schedule R of Form 1040. It reduces your actual tax liability, dollar for dollar, by up to $1,125 for a married couple filing jointly, or $750 for a single filer, and fewer than 2.4% of eligible seniors claim it. Here is who qualifies. You must be 65 or older by December 31st of the tax year, or permanently and totally disabled and have received disability income from an employer. You must have adjusted gross income below $17,500 for a single filer, $20,000 for a married couple with one qualifying spouse, or $25,000 for a married couple where both spouses qualify. And your non-taxable Social Security, pension, and annuity income must fall below specific thresholds. $5,000 for a single filer, $7,500 for a qualifying couple. Here's what most seniors and most tax preparers get wrong about this credit. The income thresholds are not applied to total household income. They are applied to non-taxable income only. A couple with $63,000 in total income, like Arthur and Constance Whitfield, can qualify if the right portion of that income is structured correctly. The credit calculation on Schedule R begins with a base amount. $5,000 for a single filer, $7,500 for a joint return with two qualifying spouses, and subtracts non-taxable Social Security and pension income. What remains is the credit base multiplied by 15% and applied directly against your tax bill. Let me tell you about the real people this has happened to. Martin Levesque, age 71, of Baton Rouge, Louisiana, had been filing his own taxes for 40 years using tax software. The software, a major nationally marketed brand, had a checkbox for the elderly and disabled credit buried in an interview question that appeared only after answering yes to a question about permanent disability. Because Martin was not disabled, he was simply 71. The software's algorithm never surfaced the question about age-based eligibility. Martin had qualified for the credit for 6 consecutive years. He had never claimed it. His cumulative unclaimed credit, $4,050. He discovered this during a free tax review at his local AARP tax aid site. He filed amended returns, Form 1040-X, for the 3 years still within the statute of limitations. The IRS sent him a check for $2,250. The 3-year statute of limitations on amended returns means that every year you fail to claim this credit, you permanently forfeit 1 year's worth. For a qualifying couple, that is $1,125 gone, forever, every April 15th. Here is the sublist of qualifying conditions most seniors do not know apply to them. You do not need to be retired to claim this credit. Working seniors over 65 who fall below the income thresholds qualify. The credit is non-refundable, meaning it can reduce your tax liability to zero, but not below zero. But even seniors with modest tax bills benefit fully. If you are permanently and totally disabled, the income thresholds do not apply in the same way. The credit base is calculated from your disability income directly. You can claim the credit and also claim the standard deduction. They are not mutually exclusive. File Form 1040-X for any of the past 3 tax years in which you qualified and did not claim this credit. The IRS will process it and issue a refund, typically within 16 weeks. The medical expense deduction under Section 213 of the Internal Revenue Code allows taxpayers to deduct qualifying medical expenses that exceed 7.5% of adjusted gross income. For a retiree with an AGI of $50,000, that means expenses above $3,750 are fully deductible. The threshold is 7.5%. It has been 7.5% since the Tax Cuts and Jobs Act made that rate permanent in 2020. Before 2017, it was 10%. So many seniors who stopped tracking medical expenses years ago have never recalculated under the current, more favorable threshold. Here is the 9-category list of qualifying medical expenses that seniors consistently fail to deduct. 1. Medicare Part B premiums. If you are self-employed or if your premiums are not paid through payroll deduction, they are deductible. The standard Part B premium in 2024 is $174.70 per month, $2,096.40 per year per person. 2. Medicare Part D premiums, fully deductible. The average Part D premium in 2024 is $55.50 per month, $666 per year per person. 3. Medicare Supplemental Insurance, Medigap premiums, fully deductible. The average Medigap Plan G premium for a 70-year-old in 2024 ranges from $1,380 to $2,640 per year depending on state. 4. Long-term care insurance premiums, deductible up to age-based limits. For a taxpayer age 71 or older, the 2024 deduction limit is $5,880 per person. 5. Home modifications made for medical necessity. Wheelchair ramps, grab bars, stair lifts, widened doorways, and walk-in tubs, if prescribed or recommended by a physician for a specific medical condition, are fully deductible, not as home improvements, as medical expenses. 6. Transportation to and from medical appointments. The IRS allows a mileage deduction of $0.21 per mile for medical travel in 2024, plus parking and tolls. A senior who makes 60 medical-related trips per year averaging 14 miles round trip accumulates $176.40 in deductible transportation costs, not including parking. 7. Dental, vision, and hearing expenses not covered by Medicare. Medicare does not cover routine dental, vision, or hearing care. Out-of-pocket expenses for dentures, hearing aids, which average $4,600 per pair in 2024, eyeglasses, and dental work are fully deductible under Section 213. 8. Prescription drug costs, including insulin, that exceed what Medicare covers. The IRS allows deduction of the out-of-pocket portion, after insurance, of all prescribed medications. 9. Psychiatric and psychological care, including therapy, memory care assessments, and dementia-related medical supervision, all fully deductible under Section 213, and all consistently omitted from senior tax returns. Let me tell you about the real people this has happened to. Lorraine Oduya, age 69, of Memphis, Tennessee, spent $9,840 in qualifying medical expenses in tax year 2023, including $2,412 in Medicare premiums, $4,600 for hearing aids, $1,200 for dental implants, and $1,628 in prescription costs. Her AGI was $41,300. Her deductible threshold, $3,097.50, 7.5% of $41,300. Her deductible medical expenses, $6,742.50, the amount above the threshold. Her tax preparer did not ask about medical expenses. The software defaulted to the standard deduction without running the comparison. Lorraine overpaid federal income taxes by $810 in a single year, and she has 3 years to file an amended return. The itemized deduction for medical expenses only helps you if it exceeds your standard deduction. For 2024, the standard deduction for a single filer over 65 is $16,550. For a married couple both over 65, it is $32,300. But combined medical, mortgage interest, and charitable contributions frequently push itemized deductions above that threshold for retirees, and most preparers never run the comparison. Run the comparison every year, without exception. The qualified charitable distribution, authorized under Section 408D8 of the Internal Revenue Code, is the single most powerful tax move available to charitable seniors over 70 and a half, and it is used by a fraction of the seniors who qualify. Here is how it works. If you are 70 and a half or older and own a traditional IRA, you can direct your IRA custodian to transfer up to $105,000 per year directly from your IRA to a qualified 501(c)(3) charity, without that distribution ever appearing as income on your tax return. It counts toward your required minimum distribution, but it is excluded from your adjusted gross income entirely. That exclusion triggers 3 separate financial benefits simultaneously. Benefit 1, it reduces your adjusted gross income, which reduces the taxable portion of your Social Security benefit. Up to 85% of Social Security benefits are taxable when combined income exceeds $44,000 for a married couple. A $10,000 QCD that reduces combined income from $46,000 to $36,000 can reduce the taxable portion of Social Security by as much as $5,100, saving $612 to $1,122 in federal tax depending on your bracket. Benefit 2, it reduces your modified adjusted gross income for Medicare IRMAA purposes. A $12,000 QCD that keeps your MAGI below the $206,000 married filing jointly IRMA threshold saves $1,677.60 per year in Medicare Part B surcharges per person. That is $3,355.20 for a couple. Benefit 3, it eliminates state income tax on the distributed amount in the 43 states that tax IRA distributions. For a Tennessee resident in the 6% bracket, a $10,000 QCD saves $600 in state income tax, in addition to the federal savings. It is not a deduction. It is not a credit. It is an exclusion. The distribution never enters your taxable income at all. Let me tell you about the real people this has happened to. George and Helen Fassbender, ages 72 and 71, of Springfield, Illinois, had been donating $8,400 per year to their parish by check from their checking account every month at $700. Their IRA balance was $341,000 and growing. Their RMD for 2023 was $14,820. They took the full $14,820 as a taxable distribution, paid federal tax on it at 22%, and then wrote their charitable checks from their after-tax checking account. Their tax preparer never mentioned the QCD. The cost of that omission, $1,848 in federal tax paid unnecessarily every year on a charitable contribution they were already making. Switching to a QCD in 2024 eliminated that $1,848 tax bill entirely, reduced their state income tax by $504, and because it dropped their MAGI, eliminated their Part B IRMAA surcharge of $838.80 per year. Total annual benefit of one conversation their preparer never had, $3,190.80. The QCD must be made directly from the IRA custodian to the charity. It cannot pass through your hands first. It cannot go to a donor-advised fund, and it cannot be claimed as a charitable deduction on Schedule A because it was never included in income. That double benefit, exclusion from income plus a Schedule A deduction, is the one thing you cannot do with a QCD. If you retired from a company that offered its own stock inside your 401k and you are planning to roll that 401k into an IRA, stop. Before you do, read this section. Net Unrealized Appreciation, NUA, is a tax provision under Treasury Regulation 1.402A-1B that allows you to take a lump sum distribution of employer stock from a 401k plan and pay ordinary income tax only on the cost basis of the stock, the price your employer paid for it when it went into the plan. The appreciation above that cost basis, which can be decades of stock price growth, is then taxed as a long-term capital gain when you eventually sell the stock. Not as ordinary income, as long-term capital gain. Here is why that distinction matters. Ordinary income inside a traditional IRA is taxed at your marginal rate, 22%, 24%, or higher for many retirees. Long-term capital gains are taxed at 0% for single filers with income below $47,025, or married couples below $94,050 in 2024. For a retiree in the 0% capital gains bracket, the NUA strategy converts decades of stock appreciation from 22% ordinary income tax to 0. The specific dollar exposure this protects: if an employer stock position inside your 401k has a cost basis of $18,000 and a current value of $214,000, the $196,000 in appreciation, if rolled into an IRA, becomes fully taxable as ordinary income when distributed. If distributed as NUA instead, that $196,000 is taxed at the capital gains rate, potentially 0%, saving up to $43,120 in federal income tax on a single distribution. The rules are strict. The distribution must be a lump sum distribution, the entire plan balance in a single tax year. It must follow a triggering event: separation from service, reaching age 59 and a half, death, or disability. And the employer stock must be distributed in kind, as actual shares, not converted to cash inside the plan first. This strategy must be evaluated before you roll over. Once the 401k is inside an IRA, the NUA opportunity is permanently gone. The Roth conversion, moving money from a traditional IRA to a Roth IRA, is taxable in the year of the conversion. That seems like a reason to avoid it. For retirees in the right income window, it is precisely the opposite. Here is the specific window that makes a Roth Conversion Ladder work for retirees. The window opens when your current year taxable income, after deductions, falls below the top of the 12% federal tax bracket. For 2024, that ceiling is $47,150 for a single filer, $94,300 for a married couple filing jointly. The window closes when the converted amount pushes you above that ceiling, into the 22% bracket. Inside that window, every dollar converted from a traditional IRA to a Roth IRA is taxed at 12% or less. Every dollar that sits inside the Roth after conversion grows tax-free, distributes tax-free, and, critically, is never subject to required minimum distributions. Ever. The three simultaneous burdens this eliminates when executed correctly over 3 to 7 years. Burden 1, the RMD tax bomb. Every dollar converted today reduces your future traditional IRA balance, which reduces your future required minimum distributions, which reduces your future taxable income permanently. Burden 2, the Social Security tax trap. By reducing traditional IRA balances before age 73, a Roth conversion ladder lowers the combined income that determines how much of your Social Security benefit is taxable. Reducing future RMDs by $8,000 per year can eliminate the taxation of $6,800 in Social Security income, saving $816 to $1,496 per year at the 12% to 22% bracket. Burden 3, the IRMAA surcharge. Medicare, IRMAA, is calculated from your tax return 2 years prior. Converting strategically today, keeping MAGI below $103,000 for a single filer or $206,000 for a married couple, prevents a spike that would raise your Part B premium by $69.90 to $419.30 per month 2 years from now. The ladder requires annual recalibration. Your conversion amount must be calculated each year based on current income, current deductions, current Social Security benefits, and projected RMD growth. But the math is not complicated, and the payoff, measured over a 10-year window, can exceed $40,000 in cumulative tax savings for a couple with a $300,000 traditional IRA. Here are your 5 protection moves, one for each item I just showed you. Execute them in this order. They are free, they are legal, and they are available to you right now. Pull out your last 3 federal tax returns and check Schedule R. If Schedule R is not attached, if it does not exist in your filing, and you were 65 or older in any of those years, you may have missed the credit for the elderly or disabled. Download Schedule R from irs.gov and run the calculation yourself using your AGI and non-taxable Social Security income from each year. If you qualify, file Form 1040-X, an amended return, for each year still within the 3-year window. The average refund for this correction, $2,250 for a qualifying couple over 3 years. Before your next tax filing, collect 12 months of medical expense receipts and run a total. Include Medicare, Part B premiums, Part D premiums, Medigap premiums, dental, vision, hearing, home modifications, transportation, and prescription out-of-pocket costs. Compare your itemized total, medical plus charitable plus any remaining mortgage interest, against your standard deduction. If the itemized total is higher, you should be itemizing. If your preparer is defaulting to the standard deduction without running this comparison, ask them directly, in writing, to document why. If you are 70 and a half or older, own a traditional IRA, and make charitable contributions of any amount, call your IRA custodian today and ask them to initiate a qualified charitable distribution for your next charitable gift. Give them the charity's name, EIN, and mailing address. They will send the check directly. You will receive a confirmation letter. Your 1099-R will show the distribution, but when properly coded and excluded on your tax return, it will not increase your AGI by a single dollar. Do this before December 31st of the current tax year. If you have employer stock inside a current or former employer's 401k plan and you have not yet rolled it into an IRA, schedule a consultation with an enrolled agent or CPA this month specifically to evaluate the NUA strategy. Bring your plan's most recent statement showing the cost basis of the employer stock. If the appreciation exceeds $50,000, the NUA analysis is not optional. It is essential. Rolling the stock into an IRA without running this analysis is a permanent and irreversible mistake. Ask your tax preparer before your next filing to calculate your optimal Roth conversion amount for the current tax year. The question is simple. How many dollars can I convert from my traditional IRA to a Roth IRA this year before I exit the 12% bracket? If your preparer cannot answer that question with a specific dollar figure within 10 minutes, you need a different preparer. And now the bonus move. I call this the Retiree Tax Floor Strategy. It is a 3-year tax projection built on a single spreadsheet that maps your AGI, your taxable Social Security, your IRMAA exposure, and your Roth conversion capacity simultaneously. It identifies the exact dollar amount you can convert, distribute, donate, and deduct each year to keep your effective federal tax rate below 12% permanently. I have documented the complete methodology in a 39-page guide that is completely free. The link is in the description. That guide also includes Schedule R instructions, the 9-category medical expense checklist, the QCD initiation letter template, and the NUA evaluation worksheet. In the next video, I am going to show you a 2024 change to the way the Social Security Administration calculates the taxation of survivor benefits, a change that is adding $3,240 per year in unnecessary tax to the returns of widows and widowers in 38 states, most of whom have no idea the calculation can be legally challenged. Share this video with a retiree who uses a seasonal tax preparer. They may be leaving thousands of dollars on the table every single year. Like this video. Subscribe to this channel. You now have the specific code sections, form numbers, and strategies that most retirees will never find on their own.